Zedcrest Wealth has a new report which is looking at, I guess, the midpoint of 2025 and what things look like for Nigeria's economy. There it is, charting Nigeria's next reform chapter. A number of analysts at the firm worked on it, and we have one of them with us, Samuel Aladegbaye, who is an investment research analyst at Zedcrest Wealth. Samuel, good morning to you. Thank you so much for joining the show. There's been a lot made about inflation, which your report kicks off with respect to a lot of chatter on the rebasing leading to the decentralization. But you've got a chart there, and you also talk about other factors, decentralization, leading to the deceleration rather, of inflation. Can you speak to those other metrics?
I mean, so yeah, over the last 2 years, we've seen inflation spike up, hit a record high of 34% midpoint last year. And, coming to this year, we actually expected inflation to decelerate, right, regardless of the rebasing, because we are seeing improvements in our macros. Pretty much all the unification of the FX windows, the major things, the liberalization of the downstream sector had already been done, and we expected this deceleration coming into this year. The rebasing only just adds further, reaffirmations to that projection that, yes, we'll actually see. And we've seen that coming in the numbers that we've seen so far. So
Great. Now, on the agriculture front, there's been a lot of talk about food. We have a food emergency declared by the president back in 2023, I think. Your reports points out that there are some triggers that could lead to a reduction in food prices. Can you talk us through that?
Yes. So a major headwind that we've seen in the agricultural sector, right, is that we have seen the lack of food insecurity, especially in the middle belt. And now we've seen improvements there as well. And we've also seen the results there. In Q1 numbers, we saw an increase in our non-oil exports, of which agriculture was a very, very large chunk of that, roughly over about a 25% jump compared to Q1 last year. So we're seeing that improvement. We're seeing that we expect that it will also continue to persist into this year. If you look at the budget, the largest chunk of allocations goes to securitization, right? And we expect that this will also filter into the results that we'll see in the agricultural sector going into the year.
Great. So we're looking at possible further deceleration in inflation and also food prices coming down. The Monetary Policy Committee would likely take note of that. Your report says that we could see a pivot. Talk us through that. How could we possibly see a pivot from the MPC?
I mean, pretty much. So, as we know, the monetary policy interest rate, 27.5. Our target, or our expectation rather, is somewhere around Q4, we should see them start to ease. Right? We know that the central bank governor has been emphasizing on real return. Currently, if you go to the fixed income market, the one-year instrument gives you a yield of roughly 23%. Right? Inflation is around 23%. We expect them to hold, whereas we have just seen this deceleration start. So we expect that somewhere into the ending of the year, Q4 in particular, we expect them to cut maybe a 25 to 50 basis point cuts, and we start to see that persist into 2026, where our macros are improved and especially the interest rate becomes a little bit more expansionary.
I really enjoyed reading this report. You touched on a lot. You touched on the yield trajectory, right? So the influence of the monetary policy rates on the fixed income rates on treasury bills. How are you seeing things working out there?
So like I also alluded to, right, fixed income yields, treasury bills, 22-23. On the 10-year bond, you can get maybe 18.7, 19 if you're very persistent. But, our expectation is that going into the year, we should see the fixed income yields on the shorter end of the curve, that's the treasury bill instruments, taper towards 21, 22. Right, we saw it start at 28, now it's at 22, 23. We expect it to go towards 21, 22. For the bonds, we expect it to taper a lot more. So you're going towards 17% on the 10-year bonds to be precise. You might ask, why is it not that? Why are we not adding a little bit more legway for it to come down some more, especially on treasury bills, right? And if you look at the budget, you see that we actually have a lot more that we want to borrow. I think we might touch on that as the inflation goes on. And maybe there might be some upward pressure from that increased supply. But as the macros look, the cost of those borrowing needs, given the reduction in inflation figures, should also offer some support to make the yields come down a bit. So there's a complex interplay there.
Gotcha. So, speaking of the budget, so you're worried about the deficit. What is it? That's 6 trillion in revenues, about 49 in expenditure, about 13 trillion. So, and then we've got this from your report there, the annual, or rather the expanding annual budget deficit. So, can you lay out the concerns?
Okay, so we're coming from a deficit of 9 trillion to a deficit of 13 trillion.
Yeah.
Whilst we understand that the federal government is trying to be ambitious, spend more, you would also have to want to consider the fact that the fact that you're spending into an environment that there's disinflation, could that possibly stoke some more inflation going forward? Because if you would look at economies, the way developed economies will operate, typically you would run a deficit when you're trying to be expansive, right? And you run a surplus when you're trying to contract, so you take more revenues from the economy. But now you're having a deficit where you're planning on spending more, and you're going into a period of, moving from a period of high inflation into a period of lower inflation. So could that stoke up inflation? That's not what I'm saying.
Gotcha.
I'm just saying that the possible bear cases in that scenario.
Okay. Now let's get to oil. And again, you've got concerns on the revenue side based on production and and price. You mentioned the $60 range that we've been trading. However, there is this update with the Israel attack on Iran. So does that, do lay out your concerns for oil, but are you, I guess, willing to adjust if prices are sustained on the higher end?
Yes. As at the time when we were writing the reports, the oil prices, Brent benchmark was roughly around $65 per barrel. Now it's at 73. It's like if you refresh that, it's going up another $1. You alluded to that earlier on. So it's a very volatile commodity. It has been over the past few years. And we're really anchored on that. Now, our expectation, looking at the government's budget, you have 2 million barrels per day projections. We don't think it's going to hit that. We expect it to settle around 1.6, 1.7 at best. Oil price is $75 per barrel. For the greater part of Q2, we haven't seen that happen, right? And we do expect, yes, we've seen Israel's attack on Iran prop up oil prices, but is that sustainable? Netanyahu says we might see this for 200 days, but is that really sustainable going into the end of the year? Especially when OPEC is saying that they're trying to regain market share that they've lost to the Americas over the past couple of years. So we think oil prices might still be a bit subdued, not definitely at $75 per barrel as of now. Maybe we might see an improvement to maybe from the previous levels, maybe like $73, $70 per barrel on our own particular Bonnie Light benchmark. But altogether, I don't think it's going to come in line with the government's assumptions.
Gotcha. Okay, so tell me about your projections in terms of debts for the year, and a bit scary. I think debt stock is 162 trillion. Then you've got a debt to GDP of 58.3, and then a debt service to revenue of 150%. So talk us through that, because these projections are a bit scary.
Yes. So. Yes, whilst we expect that in terms of what you would even record in terms of GDP will be wider, so you might see a larger figure. But also in terms of debt, we ended the year roughly at 140, last year, roughly at 148 trillion. And we have it at 160, over 160. Now, if you look at what we expect to borrow from the debt markets, multilateral loans and normal debt raisings will come to over 10 trillion naira already. And if you add that plus some of the loans that we've already gotten from the likes of the China and bilateral lenders like China Afrexim Bank and World Bank, we've already got $2.2 billion from there, right? So we expect that our debt stock is going to increase. At Davos, which you also you attended, the Minister of Finance and Coordinating Economy, Wale Edu, talked about how we might even see them raise a Eurobond, right, this year. So we expect that there will be an increase in our public debt stock, and that should essentially print into our results. Also for debt service revenue, looking at our major source of revenue, oil receipts, whether it's taxes or whatever, from oil-related revenue, as we're seeing, oil prices are not really where we expected them to be as at the start of the year. So that gives a lower base in terms of revenue, and also the debt servicing that you have to do on top of the growing debts. We expect that to really balloon the percentages.
Gotcha. Now, foreign exchange, that's another big topic there. We have seen some relative stability. You've got a chart. Okay, this is more on external reserves, though. Yes. But I guess, do talk to us about the reserves and then your outlook for FX and I guess the naira.
Well, as at the start of the year, we started at $40 billion, currently at 38. We saw reserves at 38.5 million. Now it's around mid-May. Now it has come down to $38 billion. We expect that also really a lot of these projections are anchored on what we're seeing with oil prices, because we're looking at, okay, what would be the potential influence to our reserves from these related revenues? And also, how would the CBN be able to navigate this period of time? We know that they've been intervening in the FX markets. We expect FX, that's Nigerian, the official exchange rate, as at this time to settle at roughly 1,600 naira to the dollar, range bound, but roughly around those levels. And we expect that to be the appropriate price. I know you might allude to the fact that we've seen a decline in the dollar index, right?
Right.
Come down by 10%.
Yeah.
But even if you look at the rotations out of those, or out of the dollar, a lot of those has gone towards the likes of Europe, Asia, Japan, Switzerland, and the likes, right? But we expect that as of now, with the way we analyze the risk factors of Nigeria and how investors are assessing the correct environment, it might take some time before we start to see those inflows coming into Nigeria.
So do you think that, because I know you have another chart on the spread between the parallel markets and the official rates, do you expect those to, there it is, I love this. Do you expect those to stay close, or how do you see that? Do you see that widening, or what do you see there?
We expect a marginal widening as liquidity might become more. Maybe if the CBN starts to pull back on some of those interventions, we expect that to widen a bit, but nothing beyond 5% of what the official market is doing. Okay,
all right, cool. Now, so I guess overall then, how does one describe your outlook for the mid-year? Is it cautious, bearish? I mean, I'm not sure if I'll go bullish. I think it's either going to be cautious or bearish. How do you, or cautiously optimistic rather? What's the overall theme?
Right, or you hit the nail on the head, cautiously optimistic. Because yes, the macros are improving, right? Even in terms of, if you look at the real sector, the businesses, they are actually experiencing a favorable backdrop. But then you have a period of time where there's also a lot of risks in terms of what's going on with oil, what's going on with the receipts from these particular commodities and the likes. But I would say it's cautiously optimistic. We still expect the government to be sound. It's just that there's a lot of uncertainty around what those projections are going to be. I'm sure even the government has to admit that as of right now, what they assumed is really looking a bit, off what is actually coming to play. So it's cautiously optimistic. We still think we have the capacity to defend our debts essentially and money that we raise from the capital markets, but it's cautiously optimistic.
Hey, great report. Thank you for joining us to talk about it. Samuel Aladegbaye, investment research analyst at Zedcrest Wealth. Appreciate your time. Thanks so much.